Hello, this is William Jefferson Black, the publisher of Transaction Advisors. Honored to be here with Stephen Morrissette, who is a professor at the University of Chicago's Booth School of Business, to talk about what's happening in the M&A environment, in particular in 2020, when we're seeing a record decline in economic activity, a challenge from the COVID-19 pandemic, and yet some interesting opportunities that are also presenting themselves in the M&A climate. Before we get underway on our conversation, let me ask Steve first to introduce himself, talk about a little bit of his teaching, and then we'll get underway with our discussion.
Well, Will, thank you. It's great to be here with you and talk about sort of an interesting time in M&A. As you mentioned, I've been teaching mergers and acquisitions strategy at the Booth School at the University of Chicago for about 10 years now, where we focus on doing the right deals. I guess today we should say doing the right deals at the right time might also be relevant. I've also done M&A in private practice for 30 years. For about the last 10 years, spending a lot of time with private companies, doing strategic planning with them and buy-side M&A planning. But also doing ownership strategy and exit planning, which ends up being a sell-side situation. And so, as we know, 99% of transactions are private company is involved, public buying private, private buying private, and obviously financial sponsor private equity firms buying private companies. So these are interesting times, and I look forward to chatting with you about it today.
Well, I really appreciate you being here with us today, and it's really a challenging and interesting time. There are opportunities, but there are also risks in continuing to pursue both in-process deals and to pursue new transactions that may present themselves, whether those be strong companies or those that are distressed and looking for an acquisition. But let's start just by talking about the landscape that you're seeing. In terms of sourcing deals and deal flow, we've seen some broad statistics about a decline, certainly in economic activity, and a decline in deal flow as well. But how would you characterize that decline? Is it really as significant as the economic decline?
I mean, deal flow has basically stopped. I can tell by the number of private equity firms that are suddenly calling me for catch-up Zoom meetings. Same thing if you talk to lenders into M&A transactions, their volume is down. I was on the conference call with one today, and they're lucky to see one deal a week right now, compared to previous times where it would be several a day. So volume is definitely down. The data does show that these are often some of the best times to do transactions. When you look at the returns, multi-year returns from transactions done in downturns, they're generally superior to those that are done in stronger economies. Now, obviously, we don't have a lot of data about economic downturns of this type. It's early on. Most of us, any kind of deal practitioners or anybody involved in it, many have been through war or those types of disruptions or natural disasters, but not many of us were around during the Spanish flu pandemic, 100 years ago. So this is different, and we'll see. If it's V-shaped, we'll see sort of normal volume come back. We'll talk about the timing of that perhaps in a minute. But it is, it's right now difficult to assess what kind of turbulence we're seeing here. Turbulence is opportunity, but is this an acceleration of change, such as the move to remote work or other online services, online shopping? Is this just transitory? Things are going to be used for a while, like ordering from sit-down restaurants to be delivered to your home. Maybe that stops, or telemedicine reverts. Or is it transformational? As we saw after 9/11, there are permanent changes to the industry. It's hard as a strategist right now, when you're thinking about how to do deals, to understand exactly what kind of change we're looking at.
Well, and Steve, do you feel like this is an opportunity for deal makers to start to shift and change their strategy? Is it typically good practice to start to look at more transformational deals, to look at opportunistic deals where valuations are depressed, deals that perhaps you may not have considered in the past, but this may be one of those unique opportunities in time? It's a strategy we hear discussed quite often, but I think there's some catches to thinking that opportunistic off-strategy M&A is really on point.
The first comment I'll make is that when in doubt, stay on strategy. All the research has shown, the data shows that deals that are on strategy get better results than doing things that are off strategy. The data clearly shows buying someone just because they were cheap or distressed, just because that, dress is on sale. If it's an ugly dress, it's an ugly dress. And no matter how cheap you get it, you still look ugly when you put it on. And so just buying the wrong thing cheap, the data has shown that that's not a good strategy. Again, my first bullet point is staying on strategy is always a good place to start. Now, with those two prefaces, the data does show that being a little more adventurous in downturns, in terms of stretching your strategic fence or boundaries, does create value. And also is strategy changing. That goes back to what changes in the marketplace and buyer behavior are temporary, which ones are permanent. And so staying on strategy right now, companies are also modifying their strategy. And if you are modifying your strategy, M&A is a great way to accelerate that modification, that evolution of your strategy. Did I sort of answer your question there, Will? Did it make sense?
Yeah, I think so. And I think, what's interesting for us to consider is that although opportunistic M&A, may be presenting itself, and although valuations may be depressed and there could be a compelling financial rationale, if the operational strategic rationale is not there, it sounds like it's a temptation, but one that may be best avoided. And I think what you've helped us understand is that the clear exception to that could be if the transaction provides operational or strategic capability, maybe more digitization, maybe a cleaner, more streamlined supply chain. If it's on strategy, it may still work, but I think the temptation, just to buy because it's cheap is one that's best avoided. And it sounds like the research over time has suggested that's the case. The other side, I'd love to have you comment on is the sell side, certainly I think we would anticipate more divestiture activity, whether that be slimming down to a core or divesting, by necessity. What are you seeing in terms of divestiture activity and things on, transactions on the sell side?
Well, we've not seen a lot of divestiture activity announced yet. We have seen businesses simplifying their portfolio. Everything from McDonald's simplifying its menu. You see Uber, simplifying some of its offerings even. And those spin-off and carve-outs are some of the reasons why you get better returns in economic downturns. And representing sort of the seller, first on the spin-off, like getting rid of a line of business or division. The research has shown there that selling off non-core assets is to create liquidity or to refocus yourself. It makes a lot more sense than selling off crown jewels, which might get you a better price, et cetera. But now you're harming the long-term success of your business. And so that's for larger companies be selling off divisions. On the sell side, looking at sort of willingness to sell. Again, most of these transactions are buying private companies. It's a little soon to tell. If it's many sellers, it takes them a while before their pricing expectations will adjust. One of the biggest gaps right now still is bid-ask spreads. People are saying that sellers have not adjusted their pricing. Not to jump into valuations, but most people are expecting a 1 to 2 multiple decline in pricing, call it 20%. And if sellers have a number in their head, they're going to wait and hope there's a V-shaped recovery and that comes back. There are some sellers who were already started a process. I literally, right before we started talking, Will, I was talking to a client who is considering an acquisition from a seller who had started a process with an investment banker. The process fell apart when the COVID thing happened. And so now he's trying to do a negotiated deal. So that seller was already started down the path. That seller might go ahead and continue to do a deal. But many sellers are going to wait this out. Now, if we get a U-shaped recession and the trough of the U is longer, as opposed to 6 to 12 months, we're looking at 12 to 24 months, then you could see some sellers who they have discovered, first of all, there's emotional exhaustion that occurs. There's also, they'll discover some challenges in their business. It could be the financial structure of their business in terms of access to capital. Some sellers are finding that they didn't have the corporate culture to deal with remote business or the IT infrastructure. And now they're looking for a partner that can sort of help improve their platform for what they see as more permanent changes in the marketplace. So sellers are sort of holding back right now, hoping that the market rebounds, and have not adjusted their price expectations, again, unless they were already sort of down the path.
Right, right. Well, and you've intrigued me too to talk about process as well as price and strategy. The decline in valuation expectations, whether it's a couple of turns of EBITDA, are going to create a different deal environment and rationalize those expectations. The other is this notion of us all connecting through a virtual environment and not having that comfort level, that handshake, that look somebody in the eye and get a sense of whether the reps that they're making about the business are going to hold true and they're going to be there to be a part of that. Are we going to see a fundamental change in the way deals are negotiated or even the terms in which deals are ultimately consummated because of a virtual process? Or are we all simply navigating in the same way we did before? It just happens to be virtual instead of at a boardroom table.
So the virtualization is going to impact all the phases significantly, even sourcing deals. But specifically in the deal phase, the ability to do diligence, what I'll call hard due diligence or empirical due diligence, looking at financials, et cetera, contracts, even getting customer information. A lot of that was done virtually before COVID, right? So I would say that for what I'll call hard due diligence, empirical due diligence, and even some qualitative or soft due diligence, customer interviews, et cetera. A lot of that was done by phone. So a PE firm would normally be calling customers to interview with them or hiring a consulting firm to do market studies. That was all done remote. The challenge is going to be around the true qualitative part of due diligence in terms of assessing the management team, in terms of looking in the whites of their eyes and figuring out if they are telling the truth, yes, to a certain degree, but it'll be more around the cultural. The integrity issues is often as much of a deal breaker as realizing that there are cultural issues that, in the case of a strategic, it would be very difficult for them to become part of our family. Or in the case of a private equity firm, it turns out that platform owner, founder, or his management team really isn't ready, to grow the way we'd like to grow them, et cetera. Those types of things are often collected. Interestingly, many buyers collect that information as opposed to what I'll call through the front door. They get that information as they do the other due diligence in those conversations that occur. That's how they collect information about or data about those cultural issues. Buyers are worried about their ability to assess that, to collect that soft data in a virtual world, because there's things you just can't do on Zoom that you can do in person. Will, did you also want me to comment on deal structure? I think I heard you ask as well.
Yeah, I think the second part that's sort of interesting to consider is whether, given there's now perhaps a greater divide in comfort and understanding of how fast the cultural integration will take place, what kind of impact the business may have, the tendency is then for deal makers to say, well, let's keep a little held back, right? Contingent considerations, looking at more complex and more dynamic earn-out structures. Do you think that we're going to see far more use of contingent or variable consideration methods within the deal structure?
Yeah, so I think this period, I've already seen it affect deal structure. First, back to being on strategy, we might not need to do a full acquisition at all. We might be able to get the benefit that we're trying to get, access to this new technology. So, we realize that we need this technology. They've got it. We might be able to do it through an arrangement other than full acquisition through minority investment, et cetera. Minority investment would be one way to sort of start the merger, but not have to go all in. And we see that very often when there's some uncertainty. But in deals where we actually want to do a full acquisition, we are seeing more contingent consideration for a couple of reasons. As I mentioned earlier, the bid-ask spread's a little wider now in terms of uncertainty. The seller says, I'm worth 9 times EBITDA, and they've got in their mind 2019 full year EBITDA and what 2020 EBITDA would have been without this disruption. The buyer is looking at it and they're saying EBITDA got cut in half right now, and I don't know what next year's EBITDA is going to be. So nailing down EBITDA. So EBITDA is, in fact, historically EBITDA has dropped, which will affect leverage. We'll talk about in a second. But uncertainty and risk has gone up. And when uncertainty goes up, multiples go down. So both EBITDA is down and multiples are coming down, and leverage is coming down. So we've got this bigger gap. And so what people are doing is saying, you want to know what? We'll give you, what used to be might be a 10 or 15% of the consideration being contingent. Now we're seeing where it's a third. So literally in a PE deal I was on recently, what was supposed to be a 2/3 cash, really 1/3 cash, 1/3 debt, 1/3 roll, real round numbers, suddenly became 1/3 cash, 1/3 earnout, 1/3 equity roll. And that 1/3 earnout, and again, these are very round numbers, they are not exact, was because EBITDA was down, and the seller says, but EBITDA is going to come back. And if EBITDA comes back, I want more money. And the buyer said, great, I'll give you more money if EBITDA comes back. And secondly, the 1/3 of the 3 turns of EBITDA, this is like a 9 turns deal, the 3 turns of EBITDA that were supposed to get financed by a lender, lenders are frozen up right now. So this allowed them to get the deal done without any outside debt at all. Getting real round numbers, 30, 40% equity from the private equity firm, a 30% earnout, and then a 30% equity roll kind of thing, and they got the deal done.
Right. Wow, interesting. Yeah, I'm glad you shared that example. I think it's interesting how quickly and how significantly some of those dynamics have changed and how that relative ratio has shifted. And certainly I think we're going to see that the governor being the ability of the leverage finance markets to support these structures is going to be a good reality check for a lot of deal makers to say, well, if we can't get it financed in an attractive way, that's a pretty reasonable assessment as to there needs to be some variability. Of course, the seller's always going to say the future is going to be great, and we're going to get this deal. We're going to qualify for the earnout, and obviously everyone hopes that's the case. But often the key is the integration. And, there's always been a notion that integration is the key to good M&A. At the same time, this has got to be the most challenging integration environment we've ever seen. So if you've set up the deal and you've got some contingencies, and now it becomes a question of integration, again, what are you seeing? What are you hearing in terms of how integration is being approached differently, given this climate that we're working in, which is often quite a bit virtual?
Well, the short answer is it's going to take longer and go slower. Which, by the way, in your DCF model, if you're a private equity firm, if the cash flow improvement doesn't start to year 2 or 3, it affects valuation, right? It affects returns. But integrations are going to take longer and go slower, trying to do them virtually. And also, often we're still trying to stabilize the business. So businesses are going through significant turbulence. So often it's, what we need to still, for the next 6 months, focus on stabilizing our customer base, stabilizing our production, how we're modified our business processes to deal with, this disruption. And then we'll start trying to make some of those other improvements that are going to generate new cash flow. So both of those, comments go to things taking longer and going slower. The old days, a lot of times you do an integration blitz, you go in, if you're a strategic, as an example, you would send in a bunch of people, whether it's IT or finance people, and they would buddy up and help the target become part of the family, and do the handoff to the extent that we're eliminating redundant business processes. But today, large corporates are being very, very careful. I was just on the phone with one of the big 4 accounting firms yesterday, and their clients are not letting people in. So the idea that you're going to get a bunch of people from a big 4 accounting firm to go in to a site to help with integration, because integration, unlike due diligence, is much more on-site work, much more FaceTime work. And so, you just can't do that right now. You can't send in a blitz group to jumpstart the integration. The old advice, those first 100 days, you want to get a lot of things going. Right now, you don't get to do anything for the first 100 days and maybe the first 270 days. So again, that will slow, things down. And the last thing I mentioned, integration, is, the best practice has always been to focus on changing the most important things first. And most important is defined as the things that create value. Why were we doing this deal? Where was the value creation going to come from? Don't get hung up on the 100 little changes that we want to do. What are the 5 things that will really drive value? And so in these times, you really want to be laser focused and know why you were doing the deal, what was going to drive value creation, and focus your change and integration efforts on those 3 to 5 things that are really key to value creation, as opposed to the 100 other things that the corporate staff wants to get done to make them part of the family.
Well, and there's lessons of how to approach deals in a tricky environment, certainly a declining economic climate. Are probably lessons learned from past recessions, from similar periods in history. And we like to look back and consider whether, for example, the recession of 2008 and 2009 has some similar characteristics, whether there are some lessons learned in terms of modifications to the process, whether that was true during the dot-com recession as well. With that said, I'm not sure that we're finding a natural place to look for wisdom from past periods. But as you study today's climate for M&A, and you think about past periods, are there any parallels that we can look at? And are there some lessons that we could draw from those past periods that would be instructive in how we navigate deals today?
As we discussed a few minutes ago, yes, there are, lessons learned from previous recessions, certainly in operating your companies properly. In terms of M&A, it's a little soon to tell. You do look for when there are changes in the marketplace, and where there's, again, transformation things happening, changing buyer behaviors, changing customers. Whether it's, if you think about now, clearly, all the remote working initiatives, issues around vendor risk management, that should create opportunities. So turbulence always creates opportunities, and is, not to sound opportunistic, but 3-4 months ago, right as soon as this started, I was in conversation with some large family offices saying, okay, where are the opportunities going to be? Would you see, again, large firms saying, my gosh, we've got to change our supply chain to reduce risk. At the end of the day, efficiency and cost reduction sort of trumped risk management in many firms for the last 20 years, because of the cost pressures to get costs down. And now, vendor risk management suddenly is going to become much more important. And you see firms changing to, requiring that there'll be 3 vendors on every buy, et cetera. Yes, so there are some general, characteristics of downturns that we can, use to identify opportunities, modify our processes. Then there are the uniqueness of this one. This is a supply side recession, which is a little different than what's called a demand side, in that supply got closed down, restaurants got closed, not because people didn't want to buy food, because, they weren't allowed to sell it. And so that's a little bit unique. I don't remember sort of a supply side recession of significance, in my career. It's always been demand side stuff. People stopped buying things, and you had to figure out how to adjust supply to the new lower demand. So we'll see it again. Most of us have not had certainly experience with pandemics, national disasters, armed conflict issues, but nothing of this scope, and uniquely global. There are many global recessions. The sort of the global impact of this is also more widespread and uniform than you see in a normal recession.
Yeah. Well, we had an interesting comment made during a recent virtual M&A summit that we hosted, and I'd be keen to get your reaction to it. And the comment went something like this, that if a company stays on the sidelines during this period of time and they don't do deals, well, their peer set does continue their M&A activity. would they not be exposed 12 or 18 months from now to activist approaches, to governance challenges of them being too shy, of staying on the sidelines during this period of time and not continue to pursue deals? How would you envision that scenario shaking out?
First, the data shows, doing the wrong thing is more harmful to the company and to your career than missing out on a good transaction. And both PE managing directors and corporate dev officers and corporate CEOs will say the same thing. They'll often say the deal we didn't do was the best decisions we ever made. Now, if your company falls behind your peer group because you didn't make the operational changes necessary, you did not read the marketplace, and if you did not do acquisitions to help you with that, but again, their mistake will be that they did not adjust to the market, to changing buyer requirements, not because they didn't do deals. Now, everyone has to be ready to move. If we've got a good corp dev process and a crown jewel that we've had our eyes on for 5 or 7 years suddenly becomes available for one reason or another, and we have our head in the sand, or frankly don't have the guts to move on it, that is something that can, be visibly damaging to your firm and to the sort of the reputation of your executive team. That's what goes to the governance here. Again, deals that are on strategy. Notice the qualification I gave to that was, this has been someone who's been on our list for 5 or 10 years. We know they'd be a good addition to our business. We know they help propel us forward, or maybe they've only been on the list for a year or two. But we've identified them as a good fit for us. We need now to be ready to move quickly on that. One of the things that happens right now from a governance standpoint, in times of turbulence like this, we can be distracted. We're worried about bigger problems in the operating business, or bigger problems in our, if I'm a board member, I'm worried about my business, that I'm CEO of, and I'm also trying to worry about this business I'm on the board of. And then you also get distortion, Will, in decision making. All the research shows that in times of stress, we tend to, it's sometimes called the tunnel vision. We tend to narrow our focus and narrow the options we consider. And so if we're right in the center of the bullseye, maybe we'll still pull the trigger. But a good idea that was sort of nearer to the edge, as our focus narrows in because of stress in the marketplace, then we might miss something that was a good idea. So I'm not talking about venturing far away from our strategy, but that second or third good idea, boards sometimes can get under stress, all human beings, but board directors are no different. We start to close in the opportunities we'll consider, the options, the choices we'll consider when we're under stress. It's a normal fight or flight thing. It's well documented. It's a biological response that human beings have. And so that's, worrisome that a board might end up passing on good opportunities because of that normal pattern of human decision making under stress.
That's an interesting perspective and observation, which I'm glad you shared, because I think we forget about the human characteristics that are driving a lot of decision making, as well as the more analytical basis within strategy and corporate activity, right? That ultimately they're humans dealing with these decisions that they need to make. And it leads me to wonder if we might jump ahead to talking about synergies. And, you talk about contracting to the core. And really, when we think about that, I think a lot of the times we're thinking about acquiring companies in your same industry and looking at synergies of being able to reduce redundant costs, looking at operational synergies. And so really sticking to the core. And so if that's one of the behaviors that happens, I think one of the challenges that I also want to help understand and consider is how that lightning rod in this environment of layoffs, of redundancies, of can ultimately create more noise and tension in the deal process. And I suspect, and I'd be curious in your views, that a deal maker is now going to need to be far more aware and far more sensitive that announcing and promoting synergies and cost reductions in this climate could be a much trickier proposition.
Will, that's a good insight. As a corporate or strategic buyer, well, your question really applies to them more than to private equity. You've got a lot of audiences to consider when you make decisions and announce decisions. Obviously, there's the stockholder audience, there's your customer and general population audience, and then there's also the regulatory and political audience. You know, firms have always been careful, and they actually craft their messages for those audiences to be appropriate for each audience. So a press release, you know, doesn't have the same amount of types of detail in it that an investor relations conference call does with a deck. And it's just, you know, the amount of detail you can have in a 1-hour conference call with stock analysts is different than you would have with, you know, a reporter at the Wall Street Journal or USA Today. And so we always want to be thoughtful about how we're going to explain why we're doing a transaction. You know, if cost synergies are a significant value driver in the transaction, we'll acknowledge those. The reality of it is we come at early integration, you know, it could be several quarters or longer before we would accomplish those synergies, given that integrations have to slow down. So to a certain degree, that allows us in our announcements to focus on the more near-term benefits or the very long-term strategic benefits, because we're not going to be closing factories and laying people off, you know, in the next quarter. Now we've got to communicate that well to Wall Street so they can model our earnings properly. And you know, actually, you know, sort of stock analysts have turned a little bit a little less favorably on M&A right now compared to the last 2 or 3 years. But you've got to be very careful. You've got to craft your messages properly. You got to be transparent. But the good news is given that integrations are not going to proceed quickly right now, we can sort of figure that out and unfold it over time.
Yeah, well, and I think you know, rolling this up a little bit too at really a global level, one of the things that we're also seeing is quite a bit more noise, as I've heard it termed, in terms of merger bans. You know, we've seen that proposed in Congress in the U.S. We've seen some calls for a prohibition on acquisitions in Europe. You know, these may not become policy, but I think they're a good reflection or indication of the broader sentiment that really reflects a concern around redundancies, in particular layoffs and synergies. You think deal makers, in addition to being more clear in their communication, should be much more proactive in terms of concessions? Is that going to become an obligation to look at remedies in local communities, for example?
So, I mean, first, you know, as a trained University of Chicago person, regulatory interference of that type, saying we're going to ban mergers or whatever. I mean, antitrust is a different conversation. We're not talking about antitrust issues here. Most of the conversation around merger bans are to avoid what some would call predatory acquisitions, where a company is temporarily weakened and we've got a company in our country that is weakened and they're going to get acquired by a company from another country. Often these are cross-border sensitivities, intra-country sensitivities, as opposed to within-border sensitivities. So, you know, the kind of turbulence we're going through, we're seeing true changes in buyer behavior and economics. So at the end of the day, if people want to buy more online and are going to buy less in stores, the number of stores is going to go down, the number of online warehouses is going to go up. And no matter, you know, we can pass regulations to keep those kinds of changes from happening, but at the end of the day, you know, trying to pass regulations to keep buggy whip companies from, you know, transforming when the world no longer wants buggy whips and they want Zoom meetings. Regulation isn't going to keep buyers from wanting different things. And so erecting frictions or barriers to keep companies from changing, to give customers what they want, always hurt everybody in the long run, including customers end up, you know, paying more for what they want. And we end up wasting resources to make things customers and buyers don't want. And so, you know, do we have to be careful as corporate executives? And always, I mean, we're always mindful of the impact on communities and employee bases. That is not new. And so do we need to be careful also in how we communicate it? Absolutely. But again, there you have to point to why the market is causing this change, as opposed to, you know, the idea that we're robber barons and somehow we're going to close this factory and make a lot of money. We're not seeing that kind of turbulence. This isn't overlapping production facility type changes. You know, it's true changes in what the market wants, what buyers want. Did I answer your question, Will?
It does, and I think what we're really talking about is governance, and what we've really touched on is some of the new and evolving and continue to be more complex challenges that board members face. I think you sit on a number of boards, and are there other issues? Are these the right issues that boards should be thinking about with regard to their responsibility to oversee M&A?
I mean, in my experience, well, boards understand what their legal and fiduciary responsibilities are. Boards always take into account all stakeholders, the community, employees, customers, as well as ownership. And all the best companies have always done a good job. Again, going back to Econ 101, if we don't have happy customers, we don't have productive employees, we're not going to have a successful business. And so boards have always been sensitive to all those stakeholders. We need to continue to be sensitive and communicate around that. But in the long run, a board of directors and a regulation can't stop buyer behavior from changing if they want different things. And so, that's one of the most important things to explain the strategic, market-driven rationale of a transaction as opposed to financial engineering. And this is just about moving around balance sheets and moving around, costs. This is about us, transforming our business in the way that customers want it to be, delivering value to them.
I think that's actually quite a positive view that I think is kind of a fun one for us to focus on, before we wrap up, which is that this opportunity, although none of us wanted to have to deal with this economic challenge, no one wanted to deal with this type of a pandemic, clearly, but it does give us an opportunity to rethink whether that's the global supply chain that we relied upon, whether it's virtual activity. And so, an exciting view is to say, well, maybe there's a chance to revisit and refresh the strategic rationale behind how the business is operated. And M&A can be an important part of that, whether it's rationalizing the supply chain with an extension or digital capabilities. And so, I suspect, and I'd be curious in your view on whether we're going to see M&A start to shift with a much more creative view, right? So it's not just about the synergies or the traditional way of things have been done, but what are the new and better ways things can be done, and certainly to embrace the new economic and social distance environment that we're operating in?
First, turbulence and change is never fun. It's always difficult, right? And so, acknowledging that, it does create opportunities and exciting ones. One of the best practices right now that firms are trying to incorporate is the speed at which they had to make changes in the first 30 days after the disruption occurred, forced them to make decisions faster than they've ever made, and to implement changes like remote working policies that would have perhaps been difficult for them to make in a normal environment. Now, in this more disrupted environment, you can make those changes, and so. You want to lock in those improvements. Think of opportunities. Imagine a world where half your employees don't have to spend 3 hours a day commuting. In a world where when you walk through the floor of your office building, you don't see half the desk empty. And that's what happened now. And so people are saying, "Hey, we're figuring out this remote work thing. Customers are figuring it out." Down to consumer behavior in our families. My wife was not a big online shopping person, and suddenly, she has no problem getting all kinds of things. I think we have our own personal Amazon driver that just comes to our house 3 times a day. And so, on the M&A front, then you look at yourself, as I said, the family office I was talking to, what are the opportunities? So what are the changes that are going to be permanent in buyers? Because you hate to do a transaction on a change that's transitory or temporary. But, what are the permanent changes that are going to create opportunities? And if our business is changing, first, we got to change our operating model, but some of the capabilities we need or some of the products we need might already exist in another firm that we can bring that firm into our family and improve our performance more quickly than if we built it from scratch. And so whether it's online ordering capabilities, delivery capabilities, being able to deliver services by video, as the world has changed, M&A can help a company adapt to those changes more quickly often than they can through just organic internal change. So that could be a good opportunity for the corp dev officers to help their companies with those strategic shifts to get it done quickly and more effectively than other methods might.
I think you've given us a lot to think about, both in terms of strategy and whether or not this climate starts to shift some of the strategic thinking that takes place. Certainly the way we think about deal structures, very specifically in terms of risk allocation and starting to look at managing variability in the deal. Integration is always a tricky topic, so appreciated your views on how that can help in more effectively in a situation like this. And certainly as we look at governance and what deals to do and the right deals to do, I think you've given us a lot to think about. And so we appreciate your time, certainly in perspective. I know you're active in the deal market today, as well as obviously your teaching work. And so it's nice to have your view, because certainly a lot's changing and everyone's curious as to how those changes could be impactful in their pursuits. So and so thank you for everyone for joining us. And this has been another interesting discussion. We'll continue to bring information and perspective in the deal process, and certainly I hope you'll continue to look to transaction advisors for help in navigating this environment and doing good and better deals for your organization and for your career. So thanks again for joining us, Steve, and hopefully we'll see you again soon live at the Gleacher Center.